The government is projecting a deficit of almost $80 billion in the 2025-2026 fiscal year. And over the next 5 years, our guest says it's talking about up to $1 trillion in spending, investment of various kinds. Of course, that's a very broad category. Is it likely this money will be well spent? Let's get more from Merril Mascarenhas, managing partner at Arcus Consulting Group. Thanks very much indeed for joining us.
Thank you for having me.
Merril, before we get into how effective the spending will be, you do see signs of fiscal discipline here. Tell us why.
Yes, let's start with the upside. I think for the first time in the budget, we've seen a split between capital spending and day-to-day operations. And that's a good thing because it adds more transparency to the budget. About $115 billion in infrastructure, $110 billion in productivity investments, and about $25 billion in housing. So this is a budget about growth and productivity with tax credits front and center, investments in capital spending, and also a focus on exports. So those, I think, are good things. What we also found stood out for us in the budget is a focus on some sectors, specifically advanced manufacturing, defense supply chains, construction, and critical minerals. So strategically, it seems like a budget that is pro-productivity and pro-growth.
What is the lesson for business leaders here? For CEOs, for one thing, you say you can't rely on just low-cost labor or simple growth in domestic consumption. So you got to change your game plan. Just enlarge on that.
That's an interesting insight there, which is I think labor is going to be a big part of the discussion over the next 5 years. Foreign workers are going to drop by 50% in Canada in the short term. We are going to see some challenges with regard to spend on the public sector, which has grown from about 250,000 in 2014 to about 367,000 today. There are some positive signs there with scaling it back by 30,000. But for CEOs, we will think they should not wait for the budget to really drive the economy. They can do three things to prepare for some of the spend or tap into some of the spend. The first is to look at how their companies could benefit from some of these investments, and whichever sectors they are in, some of these sectors may benefit substantially. To look at their tendering processes, have a better understanding of where the opportunities are, and also look at their own productivity. Productivity has been a big challenge in Canada over the past few years. One of the ways to focus on that area is to really look at their do audits of their staff and see where they have gaps in their skills over the next 3 to 5 years, but equipping themselves with where these investments are going and essentially follow the money, because there's a substantial amount of money that's going to be pumped into the economy over the next 5 years. And tapping into some of those funds could be quite advantageous for some sectors and companies.
We sometimes hear talk that the government is crowding out private investment. And I guess a critic could say these decisions are being made by civil servants with no business experience. I know they take advice from business people, but if these projects were worthwhile, wouldn't they just attract private investment?
So one of the things that hasn't made the news is regulations. So Arcus has been looking at regulations. You can find some more of this on our website, arcusgroup.ca. But in 2018, the federal government had 73,000 regulations. Today it is 360,000. So that's an astounding increase. Ontario is not far behind at 150,000 regulations. So the cost of the economy in our estimates is about $53 billion a year, and it's taking up about 32 days a year for businesses, small businesses, to manage a lot of these regulatory hurdles with regard to doing business. So it's a fine balance between investment and growth and the government managing expectations around compliance and the regulatory framework. So that is something that we'll be watching closely over the next few years. If that 360,000 number of regulations drops, and we hope it will, by even 50%, that's going to unleash some major productivity gains, because a lot of those resources that are focused, HR resources that are focused on compliance would focus on innovation.
I don't know. There's always talk about getting rid of regulations. We'll see. Just to get back, though, you didn't answer the question, though. This massive investment by the government, if these were worthwhile projects, and I know it doesn't apply to a thing like a bridge necessarily, but if these were worthwhile areas, wouldn't private capital be going into them?
Good point. I think some sectors historically, if you look at the US too, defense spending has had a lot of spillover benefits to other sectors. So we think defense spending, especially in the supply chain space of defense spending, is going to be a benefit. A lot of technical expertise in the auto sector, which has been decimated in the recent past, and we don't see that getting better next year with CUSMA up for renewal, which is, it's highly unlikely that the US is going to negotiate another NAFTA. They're going to negotiate separately with Canada and the US, and the Canada is not going to be benefiting from those discussions. So while I think, yes, public sector investments could crowd out some private sector investments in some sectors, but it could step change things, especially in critical minerals, which is a focus right now in Ontario for the Ontario government too. So in some sectors it will, in construction possibly, where we're seeing a downward trend, so it may stabilize that sector. But generally we believe, especially in an economy right now where we're going to see some challenges with exports, augmenting some of these sectors and the government investing in these sectors and then stepping aside to let innovation grow can be a benefit.
It's a fascinating area. Thank you very much indeed, Merril, for joining us.
Thank you for having me.
Merril Mascarenhas, Managing Partner at Arcus Consulting Group.